Hey guys, Brendan here. These are some crazy times we're living through, huh? My wife and I have been trying to stay as isolated as possible to protect ourselves and to protect others. Here are a few of the ways we've been entertaining ourselves while staying in our apartment. I'd like to challenge you to imitate or improve on a few of these dances. Let's see it.
I can swear, I can joke, I say what's on my mind. If I drink, if I smoke, I keep up with the guys and you see me holding up my middle finger to
Also, I've been working from home, so I've grown a little bit of a beard. What do you guys think? Should I continue to grow it out? Should I trim it? Let me know in the comments. Anyway, while I'm trying to start this video a little lighthearted, there's really no way to make light of the situation the human race is currently in. It's awful. The virus has resulted in countless changes to everyday life, including the way we work, shop, and socialize. My condolences go out to those of you who are affected. Our number one priority should be to stay safe. Please protect yourself and protect others by taking the social distancing seriously. This is the best and fastest way for us to get through this situation. But while we're on the topic of social distancing, I really don't like that term. It should be something like physical distancing. We should stay apart physically, but socially, we should still call each other and stay connected to those that we love. So all that being said about the virus, people are resilient and the markets are too. I think we'll look back at this period as a great time to invest in the market. We've been through great uncertainty and very trying times before, and the market has always come out of it. Just consider some of the tumultuous events from the past. We had the flu pandemic from 1918 to 1920 that claimed millions of lives. The Great Depression caused unemployment rates to soar over 24%. The 1970s had stagflation from the oil supply shock. This ultimately led to hyperinflation in the 1980s. Black Monday still remains the worst single-day crash in history. And in the 2000s, we had the dotcom bust, and then, quite possibly worst of all, 9/11. More recently, credit default swaps and the housing bubble almost brought down the global economy in 2008. It can be helpful to look at longer periods of time to see that the market trends upwards. As illustrated in this chart, the S&P 500 index has declined more than 20% many times since 1928, even dropping more than 40% in several extreme cases. Yet, the market eventually rebounded each time. I believe that this time will be no different. World leaders are taking an all-hands-on-deck approach. The greatest minds in the government and in the private sector are all working collaboratively as we speak. I'm confident that they will defeat this virus. And the financial markets are resilient too, and they will recover, probably faster than most people think. Also, as you can see in this chart that I've explained in a previous video, intra-year declines don't necessarily signal extended losses over that particular year, but they do show that stock markets have and always will be risky, particularly over short periods of time. That's why taking a long-term approach and staying disciplined are paramount to a successful investment experience. Also, it's times like these when an emergency fund is so important. An emergency fund should have enough cash to cover at least 3 to 6 months of your expenses. Whether you are a victim of a layoff or simply can't make money because your business is closed, you need to have enough money to take care of your daily needs first. If you need help during this time, then you should apply for unemployment. There's also chatter that the government might issue a one-time check for $1,000 or $2,000 to all American adults, but this isn't guaranteed yet. And to be honest, $2,000 isn't really that much money. Depending on where you live, it may support you for a month or two worth of daily expenses, but don't rely on the government to bail you out. Take matters into your own hands. You don't want to be forced to sell any of your investments to get through this period. At the very least, if you can't add to your investments, the next most important thing is to stay disciplined and not sell any of your investments. If you find yourself in this situation, then you should do everything you can to reduce your expenses. Some ideas may be like canceling any non-necessary memberships, things like Hulu or Netflix or Spotify or your gym membership. The gyms are closed right now, you can't even go right now to use it, but once they open back up, you may want to still consider closing that membership until you get back on top of things. Also, if you find yourself in debt, you should reach out to the companies that you owe. Many people are having tough times right now, and a lot of companies are offering relief programs. If you reach out, you can find out if they offer a program for you. Also, if you have a mortgage and you're unable to pay, as a last resort, you can reach out to your mortgage company and ask for something called forbearance. Basically, forbearance is a special agreement between the lender and the borrower to delay foreclosure. This can help give you the relief you need until you're back on your feet. So once the virus has been contained, and maybe you haven't gone back to work yet or you're looking for a new full-time job, you should consider any job to make money in the meantime. This could be something like driving for Uber or Lyft, maybe you rent out a spare bedroom on Airbnb or Vrbo, or maybe you're doing something with tax or audit to help people out. Now, I wouldn't suggest any of these before the virus has been contained. It just puts you and others at unnecessary risk. And also, they probably won't be very profitable right now because many people are not traveling, they're just staying home. But after the virus has been contained, you can try one of these jobs. And even after you get a full-time job, you can continue doing it as a second source of income or a side hustle. But now back to the stock markets. The media likes to tell you that this time is different, but they say that every time. If you haven't seen my video on media headlines, you should check it out right here. But basically, I go through from 1979 until today, looking at different headlines and seeing how the markets actually react. And spoiler alert, the majority of the time, the headlines make things seem much more dire than they actually become. The media always likes to say that these times are different, but as this chart shows, we have always gotten through these tragedies and market corrections before. We will get through it this time also. The best advice is to stay the course and stay invested. I've actually had some clients that have let their emotions take over. They forced me to sell all the positions in their accounts. I honestly believe that they will come to regret this. Now is the time when you have to be adding to your investments, not locking in your losses by selling. The markets can rebound just as quickly as they fall, and you have to be invested to get the benefits. Here is a chart showing the potential cost of missing a few of the best return days in the market. It shows the annualized compounded return of the S&P 500 index going back to 1990. The bars represent the hypothetical growth of $1,000 based on investor behavior. The data shows that being on the sidelines for only a few of the single best days in the market would have resulted in substantially lower returns than the total period had to offer. Also, historically, these best market days have immediately followed major declines in the market, like we are experiencing right now. So what steps is the government taking to try and help us and the markets get through this period? The government has reacted quickly. During the financial crisis in 2008 and 2009, they were criticized for acting too slowly. They've already cut interest rates by 1% and have announced quantitative easing 4. So first, what's the benefit of the Fed cutting interest rates? They are trying to stimulate the economy by introducing more cash into it. Interest rates are lower, so it is less expensive to borrow money. If it is less expensive to borrow money, then more people are likely to do it. The government is hoping that this additional cash will be put towards starting businesses or buying homes, among other things. Ideally, this will create more job opportunities and everyone will benefit. There is a limit to this though. Current interest rates are between 0 and 0.25%, so we can only go so low. The second thing that the government has implemented is quantitative easing 4. So what exactly is quantitative easing, or QE, and how does it help? So this can get a little complicated, but basically, the Federal Reserve will print money to purchase government treasuries from its member banks. This will infuse cash directly into the economy. The idea is that because these banks will then have more cash, they'll be more likely to lend it out at lower rates. And this ultimately helps the central bank maintain the low interest rates. Quantitative easing can fuel economic growth because money being funneled into the economy should help individuals to more comfortably make purchases. This can have a trickle-down effect on both consumer and business communities, leading to increased economic growth and market performance. The problem with quantitative easing is that increasing the money supply by printing money can cause inflation. In a worst-case scenario, the central bank may cause inflation through QE without getting the intended economic benefits. This can cause a period of stagflation. Quantitative easing generally leads to short-term benefits with the risk of making long-term problems worse. That is why it's generally used as a last resort. The benefits of QE often do not outlast the actual programs. When the central bank stops printing money, the recovery often gets put on hold, or worse, can reverse. Although the hope is that new consumer confidence will inspire a real recovery, many feel that these programs are just a short-term fix. As you can see by this chart, stock markets often fall when it is announced or speculated that the QE program will be brought to an end. The increased money supply and low interest rates from QE encourages consumers and businesses to borrow more. Some debt can help stimulate an economy, but too much can further aggravate an already fragile one. The Federal Reserve recently announced a $700 billion QE4. This is actually the 5th time that the government has used quantitative easing. Ultimately, market corrections are healthy, and we will get through this. So, how should you invest in? Back it up, buddy. 5, 6 feet, right there. Good boy. So Odie wanted to join me for a little bit. He loves personal finance. He actually probably is very knowledgeable in personal finance because he's always here when I'm making these videos and he gets to hear everything multiple times with all my different takes. So how should you invest in these uncertain times? Very simply, I recommend index funds. Index funds provide broad market exposure, low operating costs, and low portfolio turnover. For the average investor, it makes sense to buy index funds with broad market exposure rather than picking individual stocks. Investing in individual stocks has the potential to outperform index funds, but it is much more risky, and no one has been able to consistently pick individual stocks that outperform index funds over long periods of time. I see picking individual stocks more as gambling than investing. Increasing your portfolio's diversification is one of the few ways to reduce risk without giving up potential returns. Vanguard has some great low-cost mutual funds and ETFs for broad market exposure. For mutual funds, I recommend Vanguard Total Market Index Fund, ticker VTSAX. If you prefer an ETF, then I'd go with Vanguard Total Market ETF, ticker VTI. If you are currently invested in bonds or alternatives that have held up better than the stock market in this downturn, then I recommend reducing your allocation to those asset classes and increasing it to the stock market. This strategy can potentially increase your returns going forward, but no one knows when the market will bottom out. So this should be done over time as a form of dollar cost averaging. Also, if you have additional cash on the sidelines, then outside of what you need for your emergency fund, I recommend beginning to put some of that cash to work. In uncertain times like this, many people like to quote Warren Buffett. In particular, his quote that you should be greedy when others are fearful and fearful when others are greedy. That's exactly right, and I think Warren Buffett is the greatest investor of all time and a great person to follow. But instead, I'll leave you with a quote from John Bogle. For those of you who don't know John Bogle, who is a major proponent of index investing and the founder of the Vanguard Group, he said, "Your success in investing will depend in part on your character and guts, and in part on your ability to realize at the height of ebullience and the depth of despair alike that this too shall pass. This too shall pass." Remember this and keep working hard. How do you feel about the markets and the government's reaction? Is there anything else they should or could be doing? Let me know in the comments below. Also, if you like this video, please hit the like button and subscribe, and hit the bell icon so you get notifications of future videos. Please take the physical distancing seriously. That's the fastest way we're going to get through this. Stay safe, stay healthy, and take care.